Good morning, everybody. So good to see you. I see our audience is growing. So I'm going to give it a few more seconds for some more people to join us. Apologies for the slight delay. As 2020 COVID would have it, we had a few technical issues, but here we are. So let's wait for a few more people to join us. Right, we'll kick off in a few seconds. Perfect, I think we can get started. A few more people will come in and they can catch up. So good morning, everybody, and welcome to the Cash in Times of Crisis webinar. Today we are joined by Nedbank CIB, and they will be giving us a survival guide for your liquidity management. And I think it's critical during these times. So if I can invite Belinda and Gary to come on camera. Good morning, Gary. Good morning, Belinda.
Good morning, Tamara.
Good morning.
Hi, thank you for joining us and good to see you.
Good to be here, thanks.
Fantastic. So to the audience, to introduce you, Belinda Munger is the Divisional Executive of Working Capital Solutions. And Belinda will be speaking about various working capital debt structures. And Belinda has a whopping 27 years experience within both local and international banks. And we're also joined by Gary Marais, the Divisional Executive of Transactional Services Sales. He will be speaking about cash management and has 25 years experience within banks. So I think to kick it off, and I would really like to encourage the audience to firstly tell us who you are and which organization you represent. And then we're going to kick it off with a poll. So in a few seconds, you will see a poll come up on the right-hand side of your screen, and I highly encourage you to participate and let us know your thoughts. So the first poll is, the organization that I represent is an SME, a medium enterprise, or a large corporate. So I'll give you a couple of seconds, if you could share that with us. I see the polls are moving. I'll give it a few more seconds. All right, I'm going to end the poll. Perfect. So the results are in, and it seems that majority or 50% of our audience represents an SME, and then we've got a pretty even split between medium enterprise and large corporate. So thank you for that. We are going to have another quick poll. If you keep an eye out there, you'll see it in a second. Do you make use of a cash management system? And it's a yes, no. If you could all go ahead. Okay, I'm going to give it a few more seconds. Okay, I'm going to end the poll. And the results show 66% do not make use of a cash management system. So that's quite interesting. And 33% do make use of a cash management system. So thank you to the audience. Appreciate that. And I think what we're going to do is we're going to move over to Gary. So if you give me a second or two, I am going to be sharing Gary's slide. Right, Gary, can you see the slide?
Yes, I can.
Perfect. So over to you.
So the question that I wanted to ask is, how do you think corporates responded to the crisis in terms of their liquidity? So looking at the slide, which really represents the BA 900 information on both current account and investment balances, and it's comparing 2019 to 2020 for the months of January to June. The top line really represents the current accounts, and the bottom line represents the investment balances, with the left-hand side being 2019 and the right-hand side being 2020. What we see on this slide is that and probably where it's most important for me to start is that the slide is scaled in billions. So any slight increase in the curve of the graphs indicates a massive increase in the value of the balances. So if we look at the investment slide on the bottom and compare 2020 to 2019, just where I've got the number 1 there, we can see that in February, the increase in balances significantly increased. The increase in the middle band, which is most important to me, which is corporates, increased by 50 billion rand at that time. Whilst the increase in current account balances on the top was not as significant, I do read into that corporates were really managing their liquidity carefully and rather investing the funds to try and gain yield out of it. So what it really demonstrates is that in times of crisis, cash really is king. I think we can move off the slide now, Tamara.
Perfect. Thank you, Gary. Can I just interject with a question?
Sure you can.
So can you explain to me how you get information from other banks?
So Tamara, that's a good question. Most banks have the capability to send electronic information to another bank, and that bank has a cash management system which is capable of reading those statements in and then displaying it through a front end to the client. I hope that answers the question.
Sure. Thank you. I see we've just lost Belinda. No, she's back. Perfect. Gary, do you have more to add, or can I go into another question?
You can go into another question.
Perfect. So how do you propose you control amendments to the banking details?
So I would assume that the amendments are talking to the verification of bank accounts. And I think that there's 2 ways in which this really needs to be done. First of all, most banking systems provide segregation of duty, which means that there's a dual process involved in amending any details. So one person would input it and another person would then release that. And I would really want to ensure that there is a proper process in controlling amendments taking place and strictly controlled to ensure that a verification is done prior to any amendments taking place. I hope that answers the question sufficiently.
Absolutely. I think that gives quite a lot of insight. Thank you. Okay. Are we ready to hand over to Belinda?
We are ready to hand over.
Fantastic. Sorry, you froze for a second. Belinda, if you would like to come back on screen and we can hand over to you.
Sure. I'm just checking why I'm getting a blank screen.
Okay.
Just turn my camera around. It might be
We can hear you perfectly.
Shout when you can see me.
Sure. Nothing yet.
Yeah, for some reason, sorry, I seem to have, I'm not sure, it seems to go on and off. So I'll talk in the meantime.
Fantastic. Thank you. So Gary and I are going to go off camera. And Belinda, if I can go ahead and load your slide.
Sure. So, apologies that you're not looking. I'll keep trying out. I'm not sure why my camera is not working, but I think it's more important to hear me. So good morning, everybody, and thank you for attending. When asked to present on the topic, I was not sure how detailed I should go. So hoping my discussion gives you enough food for thought around how you look at some of the working capital elements to your business. As a CFO or treasurer, how confident are you that your banking facilities are right for your business? The 3 most common reasons why you will seek to raise debt funding are 1, to finance new capital expenditure, or 2, to finance bolt-on or transformational acquisitions, or 3, to provide sufficient liquidity needs for your business. We will focus on the 3rd point and understand what the optimal mix is. Managing your liquidity is made up of a number of components, as indicated in the flywheel on the slide. Information systems and a risk framework are internal functions you determine, and I'll be focusing on both the working capital and investment side, which is reflected in the green portions. Working capital is made up of a number of instruments. You have the more structured products, which assist in financing both the debtor and creditor side of the balance sheet, such as supply chain finance or debtor discounting. There is the trade element made up of instruments such as trade loans, LCs, or guarantees. And then there's the more traditional instruments such as overdrafts or short-term loans. Depending on the nature of your business, you may use certain products or a combination of them to enhance your cash flow. Tamara, over to you. I think if we can do a quick poll now, you can take the slide down.
Fantastic. Give me a second. Great. I think let's move into the next poll.
Take the slide down.
Everybody should see it. So the next poll is, have you managed to adapt your liquidity cycle to cater for the rapid changes in the market? If I can ask the audience to go ahead and make their selection. Okay, I don't see any movement. Can everybody see the poll? Not yet. Let's have a look. Let's try that again. Okay, you should be able to see it now. Perfect. I see it moving quite aggressively. I'll give it a few seconds. Okay, I'm going to end the poll and let's have a look at the results. So 63% of you have said yes and 36% of you have said no. Belinda, are those results interesting?
Yeah, interesting views, and shows a need for the businesses to be able to adapt quickly to their environments and not get caught short in order to meet their short-term obligations.
Perfect. So Belinda, could you maybe answer a question for me and for the audience? What is the difference between liquidity and working capital?
Theoretically, liquidity and working capital are not quite the same. Liquidity essentially measures a company's ability to pay its expenses when they are due, or how easily and effectively a company can access the money it needs to cover its debts. Working capital, on the other hand, reflects the liquid assets a company utilizes to make such debt payments. For example, if you can't collect your debtors in time or have slow-moving inventory, your liquidity will be low despite an acceptable working capital ratio. From a bank's perspective, we use the term working capital facilities to describe the products you use, such as overdrafts or trade loans, and the products you use for surplus cash, for example, cash management or deposits. To really go into how we manage liquidity, businesses that require debt to manage liquidity require solutions that help them improve the visibility of their cash and then consolidate and optimize it. Gary pointed out a number of benefits of cash management, and I will focus firstly on the debt components of working capital and then look at what you need when looking at investment options. For those of you who listened to my colleagues a few weeks ago, you would have heard about supply chain finance and how this form of working capital allows you to assist your suppliers get access to funding at your credit rating, which then gives you the ability to extend terms with them and hence keep cash in the business for longer. Or if you're one of those suppliers, get access to cheaper funding than you would on your own and improve your liquidity by getting cash into the business faster. For those of you who import, the use of letters of credit, specifically the UPAS LC, also allows you to use off-balance sheet mechanisms to extend your payment terms. So while these are great structures, in many instances, there may be a preference for the use of just the traditional working capital facilities, such as an overdraft or a short-term loan. To determine the ideal mix of these, what you need to consider is tenor, cost, and security of funding. While we've seen interest rates fall during this period, credit requirements are becoming more stringent, and the effective margin over the base rates are increasing. So we are seeing a rise of more prime plus rates than prime minus rates being quoted at the moment. The reason for this is, as we're in an economic downturn, there's been a sudden increase in the demand for liquidity. Many businesses rely on credit to cover their operational expenses in the face of falling sales. In addition, with a large surge in retrenchments, consumers are running up credit cards or other sources of credit to make up for a loss of income. At the same time, however, this has resulted in a decrease in the supply of credit as banks start to curtail lending in order to preserve their capital, which they need to do to cover potential future losses on expected loan defaults. Most of you hopefully have seen the local banks releasing all their results lately, and all of them with really a large increase in impairments. And in addition, businesses like yourselves are starting to release financial results with the effects of the COVID-19 shutdown generally reflecting a drop in revenue and subsequent profit. This is resulting in your internal credit ratings with the banks deteriorating, causing a need for increased impairments that need to be raised by the banks and hence a strain on capital. This vicious circle will continue until we're able to stabilize the economy and companies start returning to improved levels of profit. So with this all in mind, it's become more important than ever to determine what working capital funding mix is ideal for your business during this period. As a borrower, you need to consider whether you should raise committed facilities or uncommitted facilities, whether on demand or for a specific tenor, such as a 364-day facility. To clarify the difference, committed facilities are, as they say, it's a facility that is committed or guaranteed by the bank that as long as you do not breach any pre-agreed conditions, you will have access to these funds when you require them. These facilities can be both structured as on demand or for a set period of time. For working capital purposes, these would generally be less than 18 months, but dependent on your cash flow cycle. You might ask, well, how can a demand facility be considered committed? In terms of the Basel definition, in order for a facility to be considered uncommitted, it needs to meet two criteria. It has to be on demand and requires a form of bank intervention. Therefore, the normal overdraft facility, which gets accessed via your electronic banking platform at any time of the day, does not meet the criteria relating to bank intervention and therefore is considered committed. You effectively have access to these facilities as long as the bank has not formally sent you a letter notifying you that they plan to cancel them or are demanding payment. Now, due to the change in banking regulations post the 2008 financial crisis, banks are required to hold capital against the undrawn portion of these committed facilities, as well as the drawn portion. And for this reason, they will usually charge a commitment fee or an unutilized facility fee. Uncommitted facilities, conversely, do not attract these fees, so are generally considered cheaper from a borrower perspective. The bank is required to hold less risk capital against these facilities as no capital is held on the undrawn portion. However, the resultant risk from your perspective is that the bank retains the right to refuse drawings under these facilities at a time where you may need them. This would cause uncertainty of funding in your business, as these types of facilities are also usually the first to be withdrawn by banks during times of market stress. Furthermore, these facilities are often easier to reprice. So while banks may not choose to reject a draw under these facilities, they can certainly price them up to deter you to draw and in order to sort of stop any utilization under them. Then if you are looking to consider a form of committed facilities for a specified period, for example, up to 1 year, you're going to need to consider the relationship that you have with your bank as well as your credit profile. And whether under the current circumstances, they will even consider this type of debt, especially during these times of uncertainty. The risk to the bank is that once these facilities are granted, they're unable to cancel them without a failure of the business to meet certain terms and conditions, such as covenant breaches, etc. Ideally, these types of facilities should be negotiated in normal circumstances and not in a time of crisis. It's almost like having or trying to get a good deal on insurance after you've already had the accident. It doesn't always really pan out particularly well. Your best option then, therefore, maybe just be for a traditional short-term general banking facility, such as an overdraft, which gives you the working capital solution that you need and access to liquidity, and at the same time gives the bank a measure of comfort that they have a demand facility that they can renegotiate at any time, should there be a rapid deterioration in the financial standing of the business. I do want to emphasize, though, that a bank never wants to withdraw facilities and create a crisis within a business. And in my career, I've always seen a bank's willingness to work with their clients to try and find an amicable and workable solution in a stressed situation. In summary, from a cost perspective, committed lines do attract higher fees, but do provide a certainty of funding, while the uncommitted lines are cheaper if you don't use them, but do not guarantee access when you may need them. Then, as mentioned, margins are on the increase, and the cost of debt needs to be considered against other forms of generating cash, specifically internally generated. So, i.e., sort of extending your creditors or seeing if you can rein in your debtors through the offer of a discount. When banks look at what interest rates to levy, in addition to your credit profile, we also take into consideration what other business you do with us. So your primary transactional bank status or where you do your FX, for example, will play an important role in the interest rates quoted. And especially now, you should expect to see a bank that gets little or none of this type of business, usually quoting higher rates on the debt side. It's therefore very important that you consider whether to have a single or multi-bank approach to not only your debt, but also the rest of your banking. In conclusion, as a CFO or treasurer, you will need to weigh up the importance of either certainty of funding or managing your cost base as to how you structure your working capital facilities. We suggest you speak to the working capital specialists at your bank who can assist you with a solution that best suits your specific business needs in the current circumstances. It's also important that you revisit this regularly to ensure you have the optimal mix and it suits your specific circumstances at the time. Tamara, I don't know if there's been any questions.
Nothing has come through on the chat as yet, so if I can encourage the audience to raise your questions. And in the meantime, Belinda, could you explain to us, is there an ideal working capital range?
Thanks, Tamara. Interesting question. So having too much working capital in inventory or too many uncollected accounts is really an ineffective way of using the company's working capital and ties up cash, hence having a larger reliance on bank debt. Different types of businesses require different levels of working capital. So, for example, retailers require higher levels during peak season, while service businesses typically require a lower working capital requirement since they don't provide physical products and generally have a stable operating expense base regardless of the sales fluctuations. Research shows that it's key to maintain an optimal level, which is often kept at around 1.2 to 2 times. I think we can possibly go into our poll now as it relates to the investment side.
Sure. So the next poll is coming up. What is most important to you as it relates to surplus cash? So is it security, liquidity, or yield? If you could go ahead and let us know. We'll give them a few more seconds. Great, I'm going to end the poll. So the results are in, and liquidity definitely came in top with 66%. Next is 22%, which is yield, and 11% is security. Very interesting. Belinda,
Thanks.
back to you.
Sure, thanks. And I'm going to speak to you, everybody, about security, which they did seem to rate as the lowest. So in addition to your funding, you need to give thought of how you manage the cash within your business. Depending on the size of your business and how many entities form the group of companies, you also need to assess whether you have a centralized or decentralized treasury function. If a central treasury function makes most sense, then looking how cash management structures can assist in reducing finance costs or enhancing the credit risk you earn will be important, as discussed by Gary, who spoke about the various cash management options and solutions. If, however, you're one of the lucky ones who have a surplus cash position, besides the operational cash that you need to keep, you'll want it to ensure that you maximize the interest earned and preserve capital, although it's not always easy to accomplish both at the same time. In times of crisis, preservation of cash should remain a constant, and managing counterparty risk plays a major role in this. Maximizing returns may not be a priority during these times, particularly in a low interest rate environment. To put it simply, more important than generating yield is to avoid losing capital value. Many large corporates have a risk management framework or investment policy which determines where they place their deposits. Their treasury departments will have credit criteria based on banks' credit ratings or balance sheets or tier 1 capitalization ratios as an indication of a financial institution's credit quality. If you're a smaller business and don't have such a framework in place, you effectively need to take into account the strength of the institution where you place your money and understand what the underlying instruments are which are being used to generate returns. Banks, especially the large SA banks, are often seen as more risk-free from a capital security perspective. The risk is based on the strength of the bank's capital and their ability to pay out in the event of a crisis. On the other hand, if you're looking to invest in a money market fund within an asset manager, you should understand the underlying instruments, so you are able to determine the risk profile of the investment and whether it fits into your investment policy. Money market fund rates are usually higher than a bank, as they have the ability to invest in higher yield and longer dated instruments from several institutions. The risk, however, is that these investments is that in many instances, your capital is not necessarily guaranteed. As happened when African Bank went into curatorship in around 2014, and some of the asset managers actually had to adjust the values of their money market funds downwards to cater for the stress that was in the market. I'm going to now put up a slide, Tamara, if you can assist with that, which actually reflects the differences in products offered by banks and asset managers. So you'll see the bank deposits, the traditional ones that most of us know, the call deposits, fixed deposits, and notice deposits. And some of the banks have various sort of structured deposits that you can inquire about. Whereas the asset managers very much linked equity funds or income funds, multi-asset funds. The money markets funds generally form part of the income funds. Now, from a risk perspective, as I mentioned, when you place the money with a bank, the only risk you're taking really is the bank credit risk. Whereas with an asset manager, the credit risk is very much dependent on the underlying portfolio. And so you do need to take that into account. Also, if you're looking at credit ratings, you need to determine what the credit rating is on the particular portfolio, as each fund actually has its own credit rating within the asset manager. Thanks, Tamara. We can go into looking at my blank screen. I do apologize. I'm not sure why my camera has has eluded me. Anyway, in terms of investment periods, and some of you spoke to liquidity being most important. If you've got a high degree of confidence in your cash flow forecasts, you can consider segregating your cash deposits into a mix of call deposits, 30-day, 60-day deposits, etc., to take advantage of the higher rates offered on these longer tenors. However, for many CFOs dealing with high levels of forecast uncertainty during this period, maintaining capital value and being able to access this to meet unforeseen liquidity requirements should be your primary focus. Under more normal circumstances, however, you should really consider using a mix of short and medium-term deposits in order to enhance your returns while managing your liquidity needs. So hopefully I've given you some pointers to consider to effectively manage your liquidity, whether it's how you manage the mix of working capital debt instruments or how you achieve your liquidity goals within your business. Thank you very much, and over to you, Tamara.
Thanks so much, Belinda. I'd like to encourage the audience to raise any questions that they may have for Gary and Belinda. I see the audience is pretty quiet today. So if you want to...
Tamara?
Yes, Gary.
I think maybe I should just come in and just add in some of the details around the cash management side of things, just to complement what Belinda was talking about.
Absolutely. I'll hand over to you, Gary. Thanks.
Thank you, Tamara. So I think in these uncertain times, we need to ask ourselves if we're really making use of the right solutions and services to manage liquidity effectively. So what I'll talk to is a few practical things that businesses should be focusing on in order to manage the cash they have effectively. One of the key aspects of this, and I mean, Belinda spoke about this, but is the working capital cycle, which by definition is a measure of how quickly businesses can turn their current assets into cash. To really achieve this, you need to focus on the elements of the working capital cycle, which are money coming in, money going out, and inventory management. I will be focusing really on the first two elements, which is managing your in and outflow of cash and how you manage the funds that you have. There are really 4 questions that you need to ask yourself. The first question being, is the inflow and outflow of cash being efficiently and effectively managed? Ultimately, what companies want to do is manage the number of days receipts are outstanding and reduce these as far as possible, and manage the number of days payables are outstanding and increase these as far as possible. We use a tool to assist us with this to analyze cash flows of the companies that we work with, focusing both on collections and payments. Working with our clients to obtain deep insights into their business and banking activities, their requirements and what they are trying to achieve. Through this analysis, we are able to make recommendations of the banking solutions and services they could use for collections and payments to become more effective and more efficient. As an example, one of our hospitality clients collects funds from its timeshare clients every quarter. Historically, these collections used to include a follow-up by a salesperson to get the clients to pay these accounts. Through our analysis, we were able to assist them with automation of 80% of their collections, bringing about a process that is a lot more timely and efficient, significantly reducing the risk of non-payment and errors. In addition to this, we were also able to recommend the use of various other electronic channels, e.g. debit order collections, e-commerce for clients paying via their website or app, and card receipts. Of course, physical cash still remained, and we worked with them to come up with solutions that would get that cash into their bank as quickly as possible. On the payment side, we worked with them on establishing a shared service where all invoices were centrally controlled and payment runs were done on a weekly or bi-monthly basis. With volumes increasing, formatting errors and client beneficiary detail errors were causing delays. So what we recommended was a straight-through process with integration into the bank's systems, either via host-to-host or electronic banking, creating efficient payment solutions and reducing errors. To further help them with improving efficiencies, we introduced mobile access for payment approvals, providing the client with the ability to initiate and track their payments 24/7. So now that you have the money, the second crucial question that you need to ask is, where is my money and is it performing for me? There are really three things here that you need to pay attention to. Firstly, do you have visibility of all of your cash? Having visibility of your cash might sound like a simple thing, but in practice could prove difficult to achieve, as if you have multiple bank accounts across multiple banks and are operating on a decentralized basis. Getting this view could be difficult without an automated solution to bring everything together, achieving timely central visibility. Just before lockdown, just as an example, just before lockdown, we assisted a multinational set up a regional treasury in South Africa with visibility of their bank accounts across multiple geographies and banking institutions. This helped them understand their consolidated position and improve their working capital requirements. The second aspect to focus on here is optimizing your returns. And this can be achieved through the pooling of funds. And what pooling of funds is it's really a centralized treasury management strategy that allows companies to maximize both the credit and debit positions to receive the maximum interest benefit. This is done either through the physical movement of money or notionally, where no funds flow, the balances are added together to obtain a notional position. And lastly, are you ensuring that your cash is where you need it most? This is achieved through automated sweeping or target balances, where the treasurer is able to set up rules and through the cash management system is able to achieve these on an automatic basis. So for example, the rule could be that all accounts are swept to zero at the end of each day, or you could set up target balances of, say, 100,000 Rand. If the balance moves below this, funds are swept from the main account to the account to bring it back to the target balance, or if it moves over it, funds are swept from the account to the main account to bring it back to the 100,000 Rand. And applying these things together really brings about end-to-end visibility, optimized returns, and hence the effective management of cash flow. So moving on to the third question that businesses need to focus on is, how am I planning for the future? So in these uncertain times, it's vitally important that all businesses place attention on forecasting to understand where funds will be coming from and where they are going to be utilized. Various scenarios need to be built into these forecasts to ensure that better decision making is made if conditions deteriorate or if they improve. Part of the challenge with this is the collation of information and ensuring that the integrity is there to do accurate cash flow forecasting. And it's obvious that this is now more crucial than ever, as tightening liquidity positions means that every cent counts. Cash flow forecasting is essential as it allows you to anticipate road bumps and ensures you put your cash to use where it is needed most. The effective capability of technology plays a significant role in cash flow forecasting, and ideally this should be done through a treasury management system that is talking to your line of business system. However, if this is not possible, sticking to the tried and tested Excel spreadsheets will do, because you simply have to do the forecasting to understand what your future requirements are going to be. And then the final question that you need to ask is is my risk management effective? So there are many aspects relating to risk management to safeguard the funds that you have that need to be taken into account, such as where am I placing my funds, which is something that Belinda spoke to, segregation of duties, security, access to systems and information. What I really want to talk to, though, is two aspects of this, one being reconciliation and the other one being account verification of debtors and creditors. So firstly, with regards to reconciliation, it's extremely important that you automate these processes as far as possible. Human intervention on manual processes can cause problems with your recon and can cause you to lose money. And also with efficient and accurate reconciliations, it makes it possible for your staff to focus on exceptional items, determine what these are, and establish what needs to take place in order to deal with them expediently. So there's two things that you really need to focus on for effective reconciliations. The first one being that you are receiving your bank statements electronically, and the second one being that your references are being utilized every time that a deposit is made into your account. So to achieve that, you can make use of services from the bank where they predefine the narrative that is used for funds being deposited into your account. And that then ensures that it aligns to the reference that you're expecting. I guess here the last thing that you want to happen is that you release goods based on a mismatch of funds. The second thing that I want to talk about is the verification of account details. And it's really to ensure that you are collecting the funds from the right person or paying funds to the right person or supplier. As an example to this, I've seen instances where invoices that are being sent to a company have been intercepted. The banking details on those invoices have been altered and then on-sent to the company. The company receives these altered invoices, amends the beneficiary detail, amends the beneficiary banking details and pays, only to realize later that they've in fact paid the wrong person and lost the money because they still need to pay that beneficiary. So therefore, by simply making use of services from banks to verify banking accounts, you can mitigate the risk that you face of errors being made or being exposed to fraud. I think that really covers it. And in conclusion, what I can say is that treasurers need to know how much money they have, where it is, and how they are going to use it to meet fast-changing requirements across the business whilst ensuring they safeguard their funds. If you are focusing on these practical things effectively, this will lead to a reduction in your working capital requirements because the hidden cash in your organization is put to work where it is needed most. And that feeds directly into the company's operations, helping the organization to navigate the uncertain future with greater confidence. Tamara, over to you.
Gary, thanks so much. Super insightful, and I'm sure very helpful to the audience. I see a question has been raised by Katie Baker, and her question is, would you recommend unsecured credit lines that offer extended terms without impact on a P&L to improve cash position? So I'm not sure, Belinda, Gary, who would like to take that one?
I'm happy. I'm happy to give it a go, and sorry, I see I'm still a blank screen. So apologies again. Thanks, Katie. I'm not sure if I'm going to answer the question right. So if you do need to clarify, I do have the messages open. So you're asking of whether you should recommending unsecured credit lines that offer extended terms without impacting P&L. If you're going to look at extended credit lines, and I'm going to deal with that first. If it's for working capital, what the banks will expect to sort of see is that money coming in and money coming out. if you're needing unsecured credit lines for a period of time, so potentially out to 60 months, then you need to start looking at some of the longer term lending where you could potentially get some payment holidays. The bank would more than likely still expect you to be able to service interest. So from that aspect, you would need to be able to cover it. But it all depends on what the purpose is for in terms of extending the terms. I'm not sure how it wouldn't really hit your profit and loss, because you would need to sort of understand how, you know, paying the interest bill will obviously affect and reduce any profits. In terms of it being unsecured, I purposefully didn't go there in my discussion, because whether a facility is a secured or unsecured is actually quite unique to every organization, and as well as how the bank is going to assess it. Unsecured facilities normally are far more expensive, and if a facility is going to be unsecured, you normally have to have quite a strong balance sheet for a bank to give you a facility unsecured. Ideally, everybody would rather give unsecured facilities, because nobody wants to sort of give security or tangible security, and for the smaller businesses, invariably it's personal suretyships and things like that. But it's very difficult for me to assess the secured or unsecured portion without fully understanding what your business and what the balance sheet looks like. So I know I probably only answered potentially some of it, but if you clarify any questions, I'm happy to try and clarify that further.
Fantastic. Thanks, Belinda. Katie, I hope that answers your question. If you have further queries, you can type it in the chat right now. I see there haven't been any other questions that have come through. So, Belinda, anything else, or Gary, anything else that you'd like to add before we wrap up the session?
Gary?
So I think from my side, these times have been very, very challenging, and I think it's placed significant focus in businesses on how they are able to preserve and build their cash reserves to ensure that they basically have an insurance policy going into the future. What I guess it would have also done was ensure that they are talking to their banks around how they are able to access funds in the event that they are facing any shortfalls from a liquidity requirement. And I guess that my appeal to them is carry on doing that, because it is certainly one way of ensuring that you keep your business going.
Thanks, Gary. Belinda, any last thoughts from yours? I see a question has just come through. It's more of a statement. Securities are not 100% guaranteed. Look at Lehman Bros and Steinhoff. I don't know if you want to respond to that, or if we leave it where it is.
Yeah, look, I think, you know, if you have a look at both Lehman Brothers and Steinhoff, you know, the term black swan events tend to come up. I think, you know, I recall being in banking for a very long time. Steinhoff was the darling of the banking world, and it's very difficult for a bank to assess potential fraud within organizations. So, you know, that's always tough. And if I can sort of add to that statement in terms of maybe a comment and what we've seen, and I sort of indicated it in my commentary in terms of the relationship that you have with the bank. It is fundamentally important that when you are facing a tough time, or you know you can't meet a creditor, or you're needing to go into an excess, or for whatever reason, those lines of communication are so fundamental. In my experience, the clients that talk often to their bankers are transparent about what they're seeing, have open lines of communication, certainly get a far more help from a bank than those clients who we struggle to get hold of, go into excess without letting the bank know, and sort of have a bit of a staggered approach in terms of how they deal with the bank. They only deal with the bank when they want something. And so, you know, I think the more important aspect is really build up that relationship with your bank. It really does help. And I see a questions come through for Gary.
Yes. So, Gary, do you offer a solution or Excel sheet to your clients to assist the liquidity management?
So we don't offer a solution in an Excel spreadsheet for liquidity management. I mean, what we do offer is we've got a state-of-the-art cash management system that really brings about cash visibility and optimization of interest, along with ensuring that the funds are in the right place where you need it most through the automated sweeping facilities. In order to fully respond to that question, I think that you should talk to your bank and see what services or solutions they supply around that. If the question was around cash forecasting, it's not something that we offer and Excel spreadsheets really give you the ability to input the variables that you know of your business to try and determine what the future of your cash is going to look like.
Thanks, Gary. I see Tabiso Pelisani has also raised a question and asking, is it a good idea to increase short-term credit facilities?
I think if your business needs it, the answer is yes. So there is an ideal working capital sort of mix, and you know, if you're solely reliant on the collection of your debtors or getting cash in to be able to grow your business, you're going to be quite restricted with what you can do. And often what short-term facilities and working capital facilities allow is for you to buy that extra stock, extend terms to clients that otherwise normally wouldn't have been able to buy from you. So depending on the nature of your business, it probably is healthy to have a level of short-term credit facilities. It also helps where you have a really bad month. You know, we all know South Africa shuts down over December. Everybody delays payment as much as possible, but you're still expected to pay your staff. So it's always good to make sure that you have sufficient working capital facilities, especially that are seasonal. And sometimes that's all they will be seasonal. Over periods of time when business is slow, you probably have a need for higher working capital facilities, and you can also stagger it. So you also then, it goes back to my statement about the cost of facilities. So, you know, to have a lot of facilities that aren't being used can be quite expensive if you're having to pay a fee for them every month. So another alternative is to actually stagger your facilities over a seasonal period of time.
Thanks, Belinda. And Tabiso, I hope that answers your question. We are almost at the end of the hour, so if you do have any other questions, please feel free to type them in the chat bar and we will address them. I see the audience is pretty shy today, not the end of the world. So if there are no further questions, I'm going to go ahead and share with you the next webinars that CFO South Africa will be hosting over the next couple of weeks. So next on the agenda is Plan to Win, a playbook for financial planning in the age of urgency. So that should be quite an interesting one. And that is on the 22nd of September at 3 o'clock. Following that, we've got Predict the Unpredictable in 7 Simple Steps. This is hosted by Oracle, and it's a demo for future-proofing your business. So please do go ahead and check out cfo.co.za/events and register for all of our upcoming webinars. Again, we've got the Finance Indaba Network happening on 15th of October, so it's less than a month to go. Unfortunately, it won't be a face-to-face event this year. However, we've put together a really slick and exciting virtual event. Super interactive, lots to learn, and great speakers have been lined up. So without further ado, I would like to say thank you to both Belinda and Gary for joining us today, sharing your insights, and I'm sure there were a lot of nuggets for the audience to take away. So once again, to the audience, thank you for joining, and we look forward to seeing you at the future events. Have a good one, everybody.
Thanks,
Cheers,
tomorrow.
everybody. Bye. Thank you,
Bye.
Tamara.
Bye.